Hello and welcome to Moneylife News and Views. I'm Debashis Basu. On Friday, PayTM, which has just got listed, made a history of very unsavory kind. The largest ever initial public offering in the Indian markets, priced at 2,150 a share, opened for trading 9% down and then fell vertically. After a weak attempt to rise at around 11 in the morning, the stock came under really heavy selling pressure, again to end the day at the lower circuit, only sellers, not a single buyer, down 27.6%. Soon after, a foreign brokerage firm put out a price target of 1,200, which would have been 44% below PayTM's issue price. The business is a cash guzzler, it said, and can never be profitable. And yet, the chief financial officer of PayTM claimed we could have priced the IPO much higher, but we decided not to. We wanted to leave value for investors on the table. The next day, the stock fell almost about 13% or so. The Indian market has been on fire until now, that is the PayTM debacle. Indian companies have raised a staggering 74,000 crores through IPOs in the first 9 months of 2021, the highest in any October to Jan to October period in the last 20 years. This year, the IPO business may end up with 1 lakh crore raised. Yet, the 3 of the 4 largest IPOs are from loss-making consumer tech companies. That is PayTM, 18,300 crore, Zomato, 9,375 crore, and PB Fintech, or Policybazaar, 6,273 crore. All of them employed a common strategy of reducing marketing expenses before the IPO to show lower losses and or marginal profit. This is familiar stuff for those who have witnessed several bouts of IPO frenzy in the past 3 decades. I have documented 2 such phases in my book, Face Value. The first was in the 1993-95 period, when there was a near consensus that India would outstrip the Asian tigers in growth. After growing at 7.4% in 1994, the Indian economy was projected to grow at 9% for several years in future. Companies went on a capital raising carnival to fund such ambitious growth expectation. The government allowed Indian companies to raise capital abroad, and soon foreign investment bankers were trawling the country for companies with decent balance sheets that could be persuaded to raise funds overseas. Even lousy companies were decked up for roadshows under the tutelage of top financial firms from London and New York. It was a heady feeling and gave companies the kind of respectability they were not getting in the domestic market. Companies like Court Parenterals, Garden Silk Mills, and Flex Industries, shunned in India, became hot picks in London and Luxembourg. Towards the end of this boom, the domestic IPO market went through the roof. In January 1995, 145 issues opened for subscription. A spate of mega issues like Reliance Capital, SR Oil, Jindal, Vijayanagar, MS Shoes, and others hit the market in the first 2 months of that year. In one frenzied week in February 1995, 78 companies went public, crowning a financial year of 1,400 IPOs, many of them junk. You begin to understand the farce of 94-95 when you consider that in the 4 years afterwards, that is between 1998 and 2001, only 219 companies raised public money. There had been no serious reforms after 1993 to support such financial boom. As I wrote in Business Standard at that time, the corporate sector is complacent about the current imperfect system, the ease with which it can make a public issue, and the lack of accountability. That explains the scramble among small and large companies to enter the market at a premium. Tomorrow's winners will be not among these. The market price will not compensate for poor performance ever. As elections neared, the Reserve Bank scrambled to raise interest rates to control inflation that was caused by a loose monetary policy of those years. By late 1995, high interest rates were causing the industry to gasp, or so they claimed. Consequently, from 1996 onwards, Indian stocks went on a long slide. The next big market boom, that was in the late 1999 and early 2000, was a bipolar one. It saw old economy stocks lag and new economy stocks, that is internet, software, and entertainment, shoot up to crazy heights. There wasn't much of an IPO boom at that time. Instead, there was a boom in new fund offering of mutual funds as equity mutual funds scrambled to raise money through tech-oriented funds to put money in this overvalued tech businesses. Big subscriptions to these funds and the US listing by Indian tech companies such as Wipro and Infosys in early 2000 marked the end of this frenzied bull market. The next bull market started in April 2003 and ran till early 2008. February 11, 2008 was another historic day for the Indian stock market. On that day, Reliance Power, which collected a record 11,563 crore in its mega IPO, got listed with great fanfare. This IPO had generated bids worth over 7 lakh crore, and the issue got oversubscribed more than 72 times, as drivers and peons also scrambled to be part of the whipped up frenzy. Priced at 430 rupees for retail investors and 450 for non-retail investors, our power surged 19% to 538 rupees at listing, but nosedive within barely 4 minutes to hit a low of 333 and eventually close at 372.50. The stock never ever traded over the issue price and is now quoted at 13 rupees. We don't know whether PayTM will mark the top of the current bull market, but it certainly does embody all the elements that mark excesses. A long bull market and a highly successful IPOs that lull investors into a sense of complacency. A loss-making but arrogant company making mega IPO at an extremely high price, several similarly shaky companies waiting in the queue to raise funds, exactly like PayTM, and also an external environment marked by high inflation and possible rate hikes around the world. But then history doesn't repeat exactly the way it rhymes. Even if the PayTM fiasco does not mark the end of the bull run, at least some sanity will return to the wild IPO market that we have just witnessed. Thanks for watching. And if you liked what you watched, please do subscribe.